Hi, welcome back to Fire Realty, this 10-part YouTube series on first-time home buying. And my name is Jennifer Butterfield, and this is my co-host, Morgan
Hi,
Simpson.
Morgan Simpson.
And we are really excited to talk to you all about different areas of identifying your minimum and maximum budget for buying your first home, as well as a few new vocabulary terms as well. And before we get into some of the new information that we're going to cover in this video, I want to just briefly go over a summary of what we covered in the last video. And we explored these two different avenues of going about buying your first home, one of them being pre-qualified and the other going through a lender. And we talked about what a buyer's consultation is and how to choose an ideal realtor. And so if you haven't had the opportunity to watch that video, I highly encourage checking that out as well. But without further ado, I'm curious, Morgan, and I want to draw upon your expertise. So we are at the stage now where our buyer is ready to go to a lender and get approved for the financing for their first home. What is a lender going to look at and use to approve a client when they're ready to go through with that?
Yeah, absolutely. The one of the main things they're going to look at is your debt to income ratio. And there's all sorts of resources to figure that out. There's calculators online. There's a calculation, but essentially what it is they're looking at the percentage of your income that is utilized with fixed expenses, right? So in other words, if I made $2,000 a month and my rent, or let's say my mortgage, is the only fixed expense I have, and it's $1,000 a month, then that's a 50% debt to income ratio, right? So that's something they're going to look at to figure out your buying power. Now, generally, most lenders on something like and we will get into different loan types in another episode. So if you're curious of what kind of financing option should I go with, hold tight. We'll dig in deeper to that because that's a whole episode in itself. But usually they're going to look at, for conventional financing, up to 50%. And then FHA, they can exceed that 50%. They can go all the way up to, let's say 55% of your debt to income ratio. But when you go to a lender, it's important that the first thing you want to know is, what is my absolute top buying power, right? What is the most I can get approved for? Now, this doesn't mean that's what we're going to spend, and it may not actually work within your personal budget. But when you start out, you want to know, what's that top number? What is my absolute max buying power? And then from there, you can work out, well, is that going to fit with my monthly budget or not?
Absolutely. And so when the lender is running the approval, they're doing a hard credit check. So I think
Right.
it's important to be mindful that when I'm going and at this stage in the buying process, I've got my credit score where I want it to really be approved for this loan. And also I'm willing to have a hard check inquiry, right? To determine what my maximum budget is going to be for a mortgage. And I think too, I'm curious. So when you say fixed expenses, I want to get really clear because some people may not be familiar with the vocabulary around some of this, especially if, we're speaking ideally to people in all different ranges of the spectrum, from maybe having no budgeting experience whatsoever and really wanting to start incorporating that and getting more and more financially responsible, to maybe somebody who's been budgeting and saving for a house for a couple of years now and is almost ready to move forward with the whole process. And so I think too, it's like, a fixed expense, is that like including groceries? Is that including, I guess, a car payment? What can you kind of narrow that down for us?
Yeah, sure. And I'll give the two most likely examples of a fixed expense for anyone is going to be the bill that it costs for them to live at a place. In other words, their rent. If they don't own a house, it would be classified as rent, right? That, and then generally it's your car payment. So the definition though, or to explain it, these are expenses that happen every single month. They don't change, right? So they're a fixed amount, and they're also consistently going to be an expense every single month. So it's not going to include stuff like, what you spend at the bar every month, or what you spend at the bar one month, or your groceries, because those things can change, right?
Right.
And even your utility bills and stuff like that. That stuff will be open to change per month. I know here in Texas, like in July and August, and now it feels like maybe 10 months out of the year, we're in 3 digits. So our electricity bills are much higher than, let's say, January or December or November, right? So these are things that do not change. They're fixed. They're coming out of your pot of money you have to work with every single month.
Mm-hmm. Yeah, I think that's really, really helpful to get clarity around what the difference between the variable and the fixed expenses are. And now let's talk a little bit about income, because I think
Mm-hmm.
too, there's from my side, and for those of you just tuning in, Morgan Simpson is a licensed Texas realtor, and I am a personal finance consultant. And so we both work in these different areas, but had come together essentially to create this series in hopes of helping people get into a home for the first time. And so I think when it comes to income, I see so many different types of income, but the biggest distinguishment I see often when I'm helping my clients budget is they've got a W-2 or they're 1099. And so talk to me a little bit about, in terms of the debt to income ratio, and when a lender is going to go and approve a particular client to purchase their first home, um, what is the difference between somebody who's on a 1099 and deducts their own taxes versus a W-2 employee who has taxes deducted out of their paycheck twice a month?
Yeah, it's a really good point. And I'll start kind of with the standard, if you will, of, in other words, if you are an actual employee, you have an employer, you're on salary, you're on hourly, you're going to most likely be a W-2 situation, right? And that's generally the standard. It's more common than 1099, and it's a little more clear as well. They're going to look at your pre-tax income to determine your debt to income ratio when you're a W-2 employee. There is kind of a benefit of that. They in their minds, they see it as a more reliable source of income, because you get a set amount every month. It's not as much subject to change outside of, hopefully you're getting raises, which it would change for the better. And so that's a huge distinction there. So it's a lot easier for W-2 folks. Unfortunately, I'm not. I am a 1099 person. So for folks like us, it's a little more difficult. It's a little less straightforward. If you are a 1099 individual, if that's how you file your taxes, they're going to look at your tax returns, and they're going to see after all of your deductions and everything, what your adjusted total gross is, and go off of that. So it's a different thing. It's not like, hey, you made your 1099, you made $100,000 last year. Great. They start with $100,000 and work through that equation. No, they're gonna, because most 1099 people are taking these deductions, right? I mean, it's one of the things we kind of have to do because we're the ones paying our own taxes quarterly, as you should, or at the end of the year or whatnot. So that's a big difference. It is. Now, not to discourage you if you're a 1099 person, because I've bought multiple properties, and it's worked out. But it is a little less straightforward. And that's something that you want to strategize with the lender on, because you may be making enough money, but you may have too many write-offs. You might have too much of a amount that you're writing off, and that can kick you out of being approved for the mortgage you want. So this is just more reason to get ahead of this. You know, you want to start looking at this a year before you want to buy, 2 years if you can, and then know you can get yourself into those situations where you're really set up.
Absolutely. Yeah, so I think that sounds like a really good plan for those who are self-employed or 1099 tax filers. You know, a year, maybe a year and a half, even 2 years ahead of actually wanting to make the purchase, starting to take a look and maybe working with a CPA or whoever files your taxes, as well as a lender, to identify what the margin is in order to be sure that you meet the requirements and qualifications to get approved for a loan, right?
Yeah, absolutely.
Yeah. Okay. So, as far as what exactly our budget can do, can we kind of pivot into some of the things that people might want to consider? Say they're putting figure, I mean, I see the parallel, right? People usually already have that fixed expensive rent, right, in their budget, and whether they're budgeting or not, they pay it each month. And so when somebody's plugging in figures into a debt to income ratio calculator to kind of explore the different home prices and what that might look like, can you kind of walk us through the process? Say I'm sitting at the computer and throw out some numbers and kind of give us an idea of what that's going to look like and how we can use that tool.
Absolutely. It's a really good question. And a lot of this too does go back to if you're preparing ahead of time, you're gonna know what resources are available to you. You're gonna just be so much better suited going into this. So that's another way you can do it. So I would suggest you go to the lender first, like we said, you get that, hey, what's my max buying power today? And let's say they give you a number. Let's say they give you 500,000, right? Great, excellent. Now, you may want to look at this with your personal budget as well, and say, yeah, I know I can technically buy a $500,000 house, but is that something that fits with how I want to budget monthly and annually when I take all my bills together and I set myself up for success, right? So one of the things you can use, and they have, like you were saying, they have the debt, which is great, but you'll be dealing with the lender at that point if you're going about this the way we're suggesting. So they're going to help you with that side of things. Doesn't mean you can't utilize that, but I think there's another tool that is even more useful, and that's a mortgage calculator. So once they come back with that max buying power price, right, you may say, well, what changes if it's 100,000 less, or if it's 50 or 25 or whatever, right? You might want to sit, if you're someone who's really trying to do the work of forming a budget and, listening to some of the stuff that the tips that you give out, right? If they're spending all that time to do that, they may want to know this themselves. So you get a mortgage calculator, you can input all the information, and then you can actually see what the different monthly payments at different amounts would be. The other cool thing you can do with that is you can look, we all know right now interest rates are a little higher, right? They're higher than they've been in the last several years. So you can look at that and you can determine for yourself, hey, how much more am I paying monthly with 2% more interest? Does it make sense to wait, or should I take advantage of the fact that maybe not as many buyers are buying right now because of high interest rates, right? So there's all sorts of things you can do with it. And you don't have to do any of this. You could absolutely go back and forth with the lender and ask them to figure it out all for you. A good lender will give you mortgage estimates of the mortgage payment at different values all day long. That's not a problem. But again, some people want to know this stuff yourself. I suggest you do so you can be a little more involved in the process, and then you can look at how you want to play the numbers. So there's some great resources for mortgage calculators. They're all over the place. They're free. One of the ones that I like to use that's not really tied to any lender or company or whatever is mortgagecalculator.org. We'll put a link for that in the description as well. But that's a great place to start. And if you don't, they're going to ask you info on, how much homeowners insurance, if there's an HOA, what the interest rate is, what the tax rate is. This is when having that relationship with both a lender and a realtor already is really crucial, because they can look up that stuff for you. Hey, I'm looking in Pflugerville. What's the tax rate in Pflugerville? It's different than Austin. And if you're listening to this and you're not in Central Texas, Pflugerville may mean nothing. You probably know Austin because everybody does. Mm-hmm. But the point is, even if you're a couple miles away, different cities, you have different tax rates, different areas. So that's the type of stuff that you can input into a mortgage calculator and come back with a pretty good estimate of what you'll be paying monthly. But something else to mention, and another reason why you do this ahead of time, is you might be sitting around saving for this down payment and thinking, man, and again, we'll get into the financing types more in another episode, but just a quick look at that. Man, 20% is a lot of money, right? 500,000, 20% of that's $100,000. Who's got $100,000 sitting around just waiting, right? Not everybody, not a lot of people. So one of the importance of doing this early on is talking to the lender and saying, hey, look, what about, are there down payment assistance programs? Are there first-time buyer credits? What can you offer me there? Because sometimes some of those programs can fit really well, and you may have this big chunk of money you were saving for a down payment. Now, all of a sudden, that goes into your savings for the property, right? For things that may come up, big ticket items, or, I know what you always suggest is having 6 months worth of salary in the bank, which I think is totally a good idea, and especially if you're a 1099, let's say commission-based person, you don't know how much your income is necessarily going to be. If you're in sales or you're a contract worker of some sort, you may have months where you're making really good money, and then you may have to go through a couple months of, making very little to nothing. So having that extra sitting there is great for peace of mind. It's just a good practice, I think, in budgeting.
Yeah, and just to touch a little bit on, kind of the range of people that might be considering purchasing a home for the first time, and I'm speaking to people who are maybe not necessarily anywhere, they've completely financially illiterate in the sense that they don't have a budget, they don't even know how to budget, right? And versus the people that are getting pretty close to being able to put their down payment and get into a home and get the keys. I think there are some essentials to kind of understand here. And one thing I recommend with anybody who's new to budgeting, and I'm just going to give the condensed Cliff Notes version of how to do this, because we're here talking about it. I would say that, adding up 30 to 90 days worth of expenses and considering each expense category as a bucket. And so, we look at like food, transportation, medical, housing, utilities, and putting each expense on every line of a bank statement in one of those buckets, and then looking at the total monthly income and subtracting expenses from the income. I like to use after tax income. And every dollar has a bucket. And so being super clear about where all of that money is going, and getting prepared. And as Morgan said, 3 to 6 months ideally saved worth of income or expenses, for a W-2 or a salary paid employee, as well as a year's worth for those who are self-employed. And so, creating a high yield savings account where it's earning interest, and those expenses can be socked away. And I think having that stability and that savings in the event of an emergency happening, you can draw upon that's what those are there for. And so, yeah, that's just the condensed version of budgeting 101, but I
I,
think it's
I
important to
think
cover in
that's
this episode.
Yeah, I think that's great stuff. I think how you put it is very consumable and is clear. And you said something that made me want to remark to people is like, look, we don't. It's okay if you have no knowledge of budgeting. I mean, honestly, I really didn't. I was taught. Specifically my dad was really good at teaching me, hey, save your money. A penny saved is a penny earned, that whole thing, right? But we're not taught budgetary knowledge in school, really, in the basics, and we're not really given a whole lot of information on that. So if you're feeling like, oh yeah, I'm embarrassed about not having a full education in how to budget, most people don't, right?
Yeah.
They really don't. I mean, it's just you don't start out with that, so that's totally fine. Don't feel bad about that. Just now hey, there's some stuff that I don't know, and that's the start of knowing the thing. You got to know that you don't know it first, right? So
Absolutely. And I just want to say thank you to everybody who's joined us for this episode. And as we wrap it up, I kind of want to peer into what we're going to be covering in episode 4 of this series, which is going to be, okay, we've been approved, or at least we have a good idea of how much we can work with. Now, what are some factors that I or me and my family want to consider in terms of where the home is going to be purchased, and what goes into picking kind of what zones to narrow down in terms of buying. And so I'm excited to share more about
yeah,
that in
yeah.
the episode.
I'm super excited, and to give you a little teaser on that, we're going to give you really the top 3 to 5 things that you have to consider with location when you're looking for your property to buy. And we're going to tell you and everyone will be different, but we're going to tell you in highest importance to maybe a little trivial at the end, right? So yeah, definitely tune in for that because you're going to want to know.
Great. Well, and we look forward to seeing you on the next episode, and we'll talk to you guys then.
Thanks, guys.